Welcome to the show. I'm Andy Hagans, and today talking with an industry insider. Joining me is Robin Winkle, managing partner at Glenloch Energy. Robin, welcome to the show.
Oh, good afternoon, Andy. I'm very happy to be here. Thank you for the invite.
Yeah, and disclosure to our listeners, I discovered Robin from another podcast, the Invest Like a Billionaire podcast, which I'm a big fan of. That's hosted by my friends over at Aspen Funds. Robin appeared on that program. I'm going to link to that in our show notes. I thought there were a lot of great insights, really got my wheels turning personally, but also I think that podcast was like 6 or 8 months ago at least. So
Yeah,
it's like an eternity in the world of oil and gas.
yeah.
But before we dive in, I started picking your brain, Robin. Um, could you give us some background? How did you end up in the energy industry?
It was really through university. So I studied civil engineering. I specialized in structures and fluids. That kind of takes you into the kind of offshore arena. The only really application is oil and gas. So I started working in the UK and then the Dutch sector offshore, and then Norway and Russia, and then here. So 25 years later, I'm still doing it.
And what brought you to the States specifically?
I started my career with Shell, and I was what Shell used to call international staff. So they used to move people around every sort of 3 or 4 years. And after Russia, we were looking for somewhere that was a little easier on the family, and so we were able to transfer out to Houston. We liked it. We decided to stay, and I've been here now for 15 years. So. Yeah.
And now you have your own company, right? You're not working for a big global corporation. You have your own independent firm.
That's correct. So I started a consulting company about 6 years ago. Yeah. So we typically do business development type work. So BD strategy, origination, and transaction support for upstream oil and gas assets.
And you sent me a copy of your book that I've been reading. It's a fantastic book. I mean, a lot of times these kind of business books, they're not always well written. They're not always well edited. But for me, as you know, kind of an outsider to the industry, not the investment industry, but to oil and gas, it's very helpful. Just crash course with a lot of the verbiage. But what was interesting to me is how M&A is such a key part of the industry, right? Like in tech, M&A is almost, it's important in tech, but a lot of the largest, most successful companies, like think of Apple or Google, they're sort of homegrown and organically grown, but that's not necessarily the case in the energy industry, right?
Well, I think that's true. I think, especially over the last few years, we've seen quite a bit of consolidation. So, people essentially trying to spread fixed operating costs over more wells. And so, yeah, I mean, if you're looking to construct a portfolio which is resilient, so, it helps you ride out the peaks and troughs of the industry, then yes, M&A is an important component in that.
So, on that last podcast that I listened to with you, Robin, I think you did an amazing job of just the big picture of the context of, global energy corporations, oil and gas, the Paris Agreement, all of this stuff that I think everyday investors who maybe don't work in the oil and gas industry, they've heard about, but sometimes we're just missing context. And I think really where things start is with the narrative, right? Because there's a media narrative around energy that sort of sets the table for a lot of people's assumptions, what they think is going to happen in the future. How would you describe the quote unquote narrative around energy, big picture?
Yeah, I mean, I think we've seen historically the last few years, certainly during COVID, actually, particularly during COVID and the couple of years following it, there was very much a narrative that this is an industry of the past, that we were moving beyond certainly oil and potentially gas far faster than people had thought was possible. So if we go back to 2020, we're actually forecast where we had actually hit peak oil demand at that time. I think what we've seen as we've sort of come out of that is that that hasn't been the case. So demand currently this year, we're sitting at about 102 million barrels a day. So we're at record demand again. Supplies about 100 million barrels a day. So there's about a 2 million barrel a day shortfall as of today. And so that's one of the reasons why why if you kind of go and fill up your car at the moment, you'll notice prices are they're heading up again. Yeah, so that's something that's coming back. And I think if you look at the actual outlook for the industry in terms of demand versus the narrative, you get quite a divergent picture. So if you look at all of the major forecasters, so the EIA, which is the Energy Information Administration, OPEC, and even the IEA, which is the Information Energy Administration, Information Energy Agency, they're all predicting demand to grow through this decade and through the next. In the EIA's case, they're predicting it grows through to 2050. So you've got the sort of fundamentals on one side, you've got the
Well,
narrative.
Robert, I'm sorry to interrupt. So peak oil was not 2020 from the demand side. It might be 2030, 2040, or even 2050 may actually be peak oil in terms of demand. Because right off the bat, I'm like, well, that's not the narrative that I,
Yeah,
hear that I'm soaking up from the mainstream media at
no,
all.
that's correct. So if you look at, I mean, the EIA, for example, they have five forecasts, all of which go up. Their mid forecast, I think, has us at 125 million barrels of demand in 2050. So that's a fairly significant rise. That is, of the three, the most aggressive. It is the most optimistic in terms of demand. If you look at OPEC, they're saying we'll probably peak around 110 million barrels in the next decade and kind of flatline through to 2045. If you look at the IEA, you have to be a little bit careful with the numbers because they actually employ a different convention in their long-term demand forecast than they do in their monthly forecast and that everyone else uses. So when they talk about, well, when people talk about oil demand traditionally, it's oil plus condensate plus natural gas liquids plus biofuels. So that's the demand stack and the supply stack. And for their long-term demand forecast, the IEA have kind of taken biofuels out and put it in a separate category. So they report oil demand and they report what they call total liquids, which includes biofuels separately. So on a like-for-like basis, looking at biofuels, the IEA also think under their stated policy scenario, we'll see demand rising through next decade.
So depending on who we're asking or who we're listening to, the demand for oil is going to continue to rise for a decade or maybe 2.5 decades.
Yeah.
Is this fact reflected in the amount of capital that's being invested into, growing the supply of oil?
Well, I mean, I think we've seen over the last year a little bit of a shift there. So if you think back to sort of 2020, 2021, you saw a little bit of a divergence in how the major oil companies were dealing with things. So Exxon and Chevron were sort of doubling down, if you like, on oil. They were saying that this is our core business. We intend to continue investing in it. And, Exxon certainly and Chevron as well took, quite a bit of flack for that at the time. BP and Shell went a different way. They said, well, we're going to pursue a more aggressive transition. We're going to invest more in alternative energy sources, and we are going to consciously shrink our oils. Both BP and Shell have done a bit of a U-turn this year. So they've both come out and said, well, actually, we see demand continuing. There's a demand for the product. And while there is a demand for the product, we will continue to invest in that product. So that's, they're sort of, I think, signaling that there's going to be more capital flowing to oil and gas than there has been, for the last couple of years. And they're also they're going to be quite a bit tougher, I think, on the renewable side of the business, which, in some cases, it doesn't really, the way it's structured makes it difficult to generate the same kind of returns. And you can kind of argue whether oil companies are really good at that stuff as well. So, I think there has been a bit of a twist. But generally, I'd say we are seeing a lot less investment than we saw, say, in 2014, for example. So we haven't seen the same sort of return of capital that sustained the growth we saw over the last decade.
Okay, now, so what I'm hearing, demand for oil is going to grow, and there's been a little bit of a pivot with some of these global corporations who were, somewhat trying to pivot away from oil and gas, depending on which corporation we're talking about, whether we're talking about Shell versus Chevron or whatever. Yeah. And now that, generally there's been a bit of an about face. Uh, but from what I'm seeing, for instance, in terms of institutional investors, in terms of endowments, not every institutional investor, but a lot of them at that asset management level, at that investor level, they no longer want to invest in oil and gas because of, ESG policies at their, policy level. Do you think that is affecting the amount of capital that's flowing into this space?
Yeah, I think certainly in the US, you are seeing you're seeing kind of capital market issues in terms of raising money for oil and gas. Certainly, if you talk about the different maturities of a field, for example, that there is still capital available to buy production. That's where you're buying, producing wells. But if you talk about development and certainly exploration, those sources at scale have really dried up. It's something people are sort of, moving away from. And yeah, I think a lot of the concerns there are around this idea that you're going to be investing in a stranded asset, that you're going to put money in, start making money 5 years later, but by then demand is declining. So, depending on the maturity, I think that concern is perhaps a little overblown. I think if you're talking about exploration, yes. I mean, a typical exploration life cycle would be 10 years from discovery to first oil, and then you recover over a subsequent 20 years. So you're certainly into that. Is demand going to peak and start declining space? But in terms of development, I think, based on the current outlook, you should be okay.
Okay. Well, where does, the Paris Agreement and, at the policy level, obviously in Europe, in the United States, in some of these more developed countries, there's tremendous pressure to move to renewable sources of energy. There have been some, twists and turns over the past year, with Germany and some other countries in Europe, realizing energy security is important, right? As well as not just that strategy of renewables versus hydrocarbons, but also security. Do you see that, at that international policy level, could you talk a little bit about that, how that might affect demand? Like, in other words, do you see a scenario where demand doesn't increase as much because of policy decisions in Europe, in the United States?
Yeah. So if you look at the IEA have three forecasts. So they have stated policies, and they also have a net zero one. So they haven't updated net zero, I think, since 2021. But basically, what the net zero oil demand curve shows you is what oil demand would have to look like in a world that was compliant with the Paris Agreement, where we were going to limit temperature increases to 1.5 degrees. So that curve shows extreme demand destruction. I mean, more than 5% demand declines a year. I think, according to that one, by 2023, oil demand will be about 80 million barrels a day. So about 20 million barrels a day below where we are. So to be on target for the Paris Agreement, 1.5 degrees, that's where we should be today in terms of demand. To give you a feel for what that would look like, if you remember COVID and sort of the depths of the COVID lockdown, I think it was April or May where the oil price actually went negative at one point.
Right.
It was 70 million barrels a day. So it would be like that, but life would be quite hard. It would be like that, but you'd have a little bit more mobility. And so in a world where you say, okay, we are going to achieve the 1.5 degrees, this 1.5 degree limit, then you would see, yes, you would have to see extreme demand destruction. And because we've overshot so much, the cut would actually have to be a great deal steeper. I think the IEA came out 2 years ago and they made headlines when they said that there should be no new development to comply with the Paris Agreement. And that's true. I mean, basically every barrel should be left in the ground if we really are going to hit that 1.5 degrees.
So I know you're not an international relations expert, or
Yeah.
maybe you are actually. I shouldn't make any assumptions, but what happens if, as we get further and further behind the Paris Agreement, a realistic trajectory, what happens? I mean, is there any teeth, or do we just all do our governments all just sort of shrug and say, well, we gave it a try. better luck next time. Is there any mechanism of accountability there? Is there any,
Mm.
or does it really matter? I mean, is the Paris Agreement, does it have any teeth? I guess is what I'm asking.
Well, I think it's kind of informative because it shows you uh, what the world would have to look like and what you would really have to do to meet that target. And there is, I mean, I think we've all kind of read the papers and we can see how the kind of the discussion has developed, certainly in Europe and increasingly in the US, in favor of making more dramatic changes. But yeah, I mean, it does increasingly reach a point where it's simply impossible to correct it without really, really dramatic changes to people's lifestyles. Um,
So,
I mean,
but your point of view though is that we are so far behind the trajectory that we would need to be on to meet those goals. It would take something on the order of a technological miracle uh, to have any hope of meeting them, right? I mean, at what point do reasonable people conclude that, well, this just isn't happening?
yeah, I mean, I think if you so the first say first 30% of CO2 emissions cuts are they don't hurt that much. But after that, it does get progressively more expensive to achieve these things. And there is a point where you turn around and say, the public turns around and says, well, I do want to fly and I do want my gas stove to talk about things that we've seen here. And I do need, an electric vehicle maybe doesn't work for me, or maybe I can't afford it. So yeah, there's a point where it's simply you can't sort of force people to do those things anymore. And at that point, I think we've seen in Germany recently there's a push to ban gas-fired boilers. They want to replace them with heat pumps, and there's quite a pushback amongst the electorate about that. They're not necessarily satisfied that this is what they want to do. So as we sort of start to march towards these milestones of banning the internal combustion engine or phasing out gas hookups, I think the debate gets a lot sharper, and you're more likely to have people coming forward and saying, no, we're just not simply, we'll basically replace our government before we do these things. They just don't want to. And that's the kind of difficulty of it, I think, if you talk about the energy transition, because it's a very expensive thing.
Mm-hmm.
And the way it's discussed is not always, on both sides, I would say, very transparent. So, it's something there should be an informed public debate about, but it tends to sort of, degenerate into a sort of partisan thing where people are trying to sort of point fingers and get someone else to sort of pay for things. So
Yeah,
it's helpful.
and your point about living in a democracy, whether in the UK, of course, we had Brexit. In the
Yeah,
United States, we
yeah,
obviously have a lot of developments in our democracy in the past decade or two. If the average voter in either of those countries, in the UK or US, were asked, "Are you in favor of meeting the climate goals of the Paris Agreement?" They might say, "Well, sure, yeah, I'm in favor of renewable energy." But then if they were asked, well, would you be willing to have your standard of living decrease by 50% to
yeah.
meet that goal? Would you be in favor? Would you vote for your standard of living to decrease by 50%? The average voter is not going to vote for that, right?
No, no, no. I think that's very true, and I think that hasn't really been the discussion to date. It's been that not only is this a good thing for the planet, but it's also this energy is also cheaper. It will make us wealthier. It will provide new jobs. And as it's kind of rolled through, that's not actually what we've seen. I mean, it's like most new technologies. It tends to be more expensive to start with. In some cases, you don't need as many people, working on these things. So you see the debate today in Detroit with the Auto Workers Union
Mm.
concerned that as you shift to EVs, there will be fewer car manufacturing jobs available. That's probably a real thing. Those things are simpler to put together. So yeah, you do see you do see increasingly that debate coming to the fore. And I mean, I remember I live in Texas. I mean, during COVID, there was a big divide in the country about face masks, and some people didn't want to wear face masks, and some people would wear face masks. I can't imagine what would happen if you told people they couldn't fly anymore,
Mm.
or that they were only allowed to fly once a year. I mean, that's the kind of when you really get to the sort of the sharp end of the Paris Agreement. There really isn't a technology that allows you to live as we do today at those emissions levels.
No, you're really talking about constraining supply, right? Like you wouldn't, at a policy level, you wouldn't necessarily need to limit how many times someone could fly per year with law, but you could simply tax with a sort of a sin tax on airplane fuel or whatever, jet fuel. And so flying would be 10 times more expensive. And so, the ultra wealthy, and I think that's a theme to me, is that when you are affluent or wealthy, higher energy costs don't really affect you all that much, right? Because the goods and services and your budget and the amount of discretionary income that you have, it doesn't really matter that much. But as you kind of go down that income ladder into middle class or working class, never mind working class in developing countries,
Mm-hmm.
higher energy costs means less food, less clothing, and less basic medicine, right?
Yeah, no, that's true. I mean, if you're very wealthy, obviously energy is a small part of your discretionary expenditure. You don't notice it to the same degree. And yeah, I mean, the kind of taxes, equivalent carbon taxes involved in a Paris Agreement compliant world are, I think it would. I haven't got the sums to hand, but it's extremely expensive. Filling your filling your SUV or your F-150 would become prohibitive for most people. It just wouldn't be able to do it.
Right. And it's again at that policy level, you don't necessarily need renewable energy to be less expensive. If conventional energy is much more expensive, it's all relative, right? Then
Yeah.
the by default, then the electric car becomes the less expensive choice. And so I think policy might be moving to that. But I want to move off of policy for a
Mhm.
minute, talk a little bit more about your book. One of the things that's interesting for me, I'm coming at oil and gas from the perspective of the alternative investment landscape, just the entire landscape of private investments. So I'm really looking at this sector from through that lens of private investing. And I think it's an interesting lens because, you talked about major corporations, and a few of them have made sort of an about face from renewable energy back to oil and gas. But all of them are subject to these social pressures, political pressures, cultural pressures that the smaller companies, entrepreneurs in the private markets, that doesn't really affect them, right? Like they don't if you're in a smaller oil company with 5 or 10 employees, you have your own company culture, and you don't care what they think in New York or at Harvard or wherever. So that's one aspect that I find really interesting about the private investment landscape. Another point from your book was that some of the smaller private operators have lower cost structures
Mhm.
than the larger companies.
Yeah.
So, do you think, based on either of those factors or other factors, do you think there's an opportunity for some of these smaller operators, private operators, to achieve, better returns on capital in this environment that we're in?
So, I mean, I think what you'll see, to the extent what we have seen, is the larger companies, and so many of the companies that we're talking about here that don't face so much external pressure are actually quite large companies. If you don't have petrol stations or gas stations, so if you're not an Exxon or a Chevron, you have a much lower public profile than those companies do. People just don't really know about you, even if you are publicly listed. And so I think there is less pressure on those companies. I think the other thing you'll see, and we've always seen it actually to a degree, that the very big companies tend to do very big new things. And then when they've added as much value to those things as they can, that's when they choose to sell them. And they typically sell them to companies that are, a little bit smaller, but still quite large, sometimes private, sometimes public, because they have a lower cost structure and they can extract more value from something that the larger companies are not competitive doing. And that's happened. I mean, if we think about the US, the larger companies initially developed the US Gulf of Mexico shelf. Since then, they've all moved into deep water, and all of those properties are now managed by companies. I mean, they're still multi-billion-dollar companies. Some are public, some are private, but they are considerably smaller because they are more focused. They have a lower cost structure, and they are able to extract value. So that's been the way the industry has worked, and I think we will continue to see that happen. Yeah, what may happen with the energy transition focus is that we see that happening a bit more quickly. That we see these these large companies trying to monetize these assets earlier than they would have in the past.
And, do you see growth then in the independent, in that sort of small to mid-sized segment of the market? Is there growth occurring right now in the United States?
So right now, the issue for that segment is capital. So those are the companies that need access. Historically, would have started with access to private capital, large amounts of private capital, and that private capital isn't not there at the moment. So you're seeing this sort of this. There's a kind of gap, if you like, that currently is not being filled. In that market.
That, and honestly, it's that gap really that I find very, very
Yeah.
interesting, right? Because there are a lot of tax breaks for private investors, associated with oil and gas in the United States. Do you see that, are there any of these smaller companies, turning to even the smaller end of the private market, right? Because in private capital, it's all relative when you say smaller investors or smaller capital. If you're talking institutional investors, that can still mean hundreds of millions of dollars.
Yeah.
But at like the syndicator level, it can mean all the way down to a retail high net worth investor who's high net worth, meaning an accredited investor, but they might be investing $100,000 or $250,000, a pop. So are you seeing some of these companies, kind of, I don't want to say swimming down market, but maybe turning to alternative sources of financing for their deals?
I have to say at the moment, no, I haven't seen that. What I've seen is the people who have positions, the last 2 or 3 years has actually been pretty profitable. Your prices have been high. Everyone cut activity during COVID, so debt is lower, and those people have cash available, and they're improving their positions. What you see, so one of the issues with the industry is that there are some fairly high barriers to entry in terms of your ability to evaluate the quality of assets. So, I mean, if you mentioned the sort of retail investor at the $100,000 or $250,000 level, there are things that you can go and do as that investor personally. So you can go and you can farm into a well, or you can farm into a field, or you can even fund an uphole recompletion, for a few $100,000. But the issue is understanding what you're actually getting into, because the industry is really quite technical. And the reason that you have the Exxons and Chevrons and Shells, and the reason they have such high overheads, is because they spend an enormous amount of time and money evaluating the assets that they're looking at. And while you can do less work on simpler things, there's a sort of minimum you can't go below. So, if you're saying, okay, I want to put $200,000 into this well, to evaluate the well, I may have to do $50,000 of technical work. And that may conclude that I should not put, I mean, it won't actually give me an answer. It may give me an absolutely don't do it answer, but it'll probably just bound my uncertainty a little more. And then, I've probably just lost any upside I would have made on the well. So there's a size at which it's not really practical for individuals to participate. Now, if you have a background in the industry, if you're a geologist or a petroleum engineer, you can do a lot of that work yourself. So, okay, for those people, yes, it might make sense. But for a sort of traditional investor who may be in retail or something else, or real estate, it's quite a different space to work in.
Understood. Yeah, I mean, that would make sense. In most industries, there's a certain scale at which under which it doesn't really make sense to
Yeah,
operate. So obviously there's a certain scale here.
yeah,
Um, and there's virtues to being small, right? To the point in your book, smaller companies will often have that lower cost structure,
yeah.
but there's a point below which you can't really go, right? There's a point below which you just don't have the scale to operate as a profitable company.
You just don't have the know-how. You don't have the capital to actually function. And yeah, that bar in this industry is actually quite high. You do need quite a lot of capital. I mean,
So
if you
what
think, sorry,
what is
go
that? What is that bar, Robin? I mean, to capitalize, let's say, an exploration company, or I don't, different sorts of companies. Is there like a dollar amount that you could throw out to say, like, hey, look, if you can't fund a company or a project with this amount of money, you're not going to be able to mitigate risk. You're not going to be able to do adequate, you know, geological study, those sorts of things.
yeah. So probably the cheapest way to do things is to find a field and raise capital for development of a single field, or even buying production of a single field with some development. And so you're talking probably due diligence will be $50 to $100,000 of technical there. Your probably minimum deal size is probably maybe at the lowest $15 million just to make the whole thing work.
Mm-hmm.
You see you see what I'm saying there? So you'd be looking
Yep.
for something that's big enough. You could put maybe 15 million in. You'd want to have a return of sort of 25+%. Um, and you'd want to have it structured such that you probably were not going to lose money. So you would have to look at price and you would have to look at technical outcomes and say, is there a sort of, am I 90% certain I'll at least walk away with what I have? Ideally, you would actually want to go quite a bit bigger and spread that over 3 or 4 different investments,
Understood. And
because obviously that protects you a little bit more.
right, diversification. And Robin, I want to put a pin in this because
Sure.
I want to have you back on the show next week, talk a little bit more about oil and gas considerations from the investment standpoint. So everyone stay tuned for our next episode. We're going to have Robin back on the show to talk about some more things that I think investors are really going to care about.
Okay. Well, hey, thank you, Andy. I'll see you next week.